part 2 of the 3rd episode. So actually it's like the 4th episode of the podcast. Martijn is still here with us. So thank you, Martijn, for not running away.
I've got some coffee to keep
yeah,
going.
exactly. You keep fueling Martijn and myself, actually. And I just offered Martijn a few candies as a break, right? And Martijn said, No, I'm not gonna do it. No, because I've discipline, Kees. I'm not doing it. Which is quite funny, actually, because discipline is a very important part of a bias that can work against you. So in part 1, we talked about biases that prevent you of starting investing. And we discussed it. Ideally, you want to start as early as possible. And if it's not so early for you anymore, at least just start. Start with lump sum, ideally, according to the theory. Start with regulated long-term investment products, and ideally with a platform that's there for the long-term investment, such as the platform that you launch yourself, VanEck Direct. Now we finally, after this episode, the listeners that were not investing yet, they like immediately, obviously, open an investment account, and they're starting now. Okay, for all the people that have starting, or are investing already, there are so many biases waiting for us to basically screw things up completely.
Yes.
So we can be
so
like,
much fun to look forward to.
No, exactly, right. And the thing is, I can consider you as an advanced investor. I'm allowed to say that, right?
Yes.
With your history, starting at Optiver and now at VanEck, of course. And I dare to say, we didn't discuss this, but I dare to say that you still are sensitive to biases as well during investing.
Oh, of course.
We talked about a few behavior biases, and we already teased our listeners already for the biases during investing. What the latest bias that you were sensitive for? Be honest, Martijn. Which one was that?
I'll think about it, and while thinking about it, I'll maybe
I have one probably, but go ahead. Yeah.
Brief sort of introduction statement. So I guess the important thing about biases is that you have to become aware of them. And if you're aware of them, at least you can try not to be influenced by them. As long as you're not even aware, then you're hopelessly lost. So, for instance, what you did with the candy, I know my weakness. I know that I'm sort of likely to maybe have one, but I started sort of to train myself. And now I realize, and I was able to be very disciplined.
Because your core brain said, yes, sugar, right? I mean,
exactly. And it's all about emotions and being able to control your emotions. And it's hard. It's really hard. It's hard when it comes to food. It's hard when it comes to all sorts of other seductions. And it's hard when it comes to investing. So the first thing is become aware of it.
Yeah.
Know that you have them. And then you can start to resist a little bit.
So basically we want to make people aware now, at least, of the few most important biases.
Yeah, and if you recognize them, you can try to resist. So this was not a way to maybe try to duck the question, because I will answer it. I'm not even sure it was the most recent one, but I have a couple that I still struggle with every now and then. So one of them is that I kind of, especially just after stopping my career as a trader, I really had the idea that I knew more than most people in the market. So if anyone should be able to get some outperformance, it would be me. And I kind of learned the hard way.
Do I hear a bit of overconfidence bias?
That's the bias I'm referring to. And I was too confident that I would be able to know more than other people and therefore outperform the market. And I was proven wrong by the market. One of the ways I was proven wrong is, so I knew quite a bit about Ahold, our local grocery company. I was invested in them, and I thought, well, if anything goes wrong, I know so much about Ahold. I read up, I keep up to date with all the news. I'll be the first person to know, and then I'll be able to sell out of my position before something really bad happens. Yeah, well, it was over 20 years ago, and one morning I woke up and Ahold was basically caught up in a bookkeeping scandal in the
that one.
US. And I was just as surprised as the rest of the world, and no way that I knew it before anyone else did. So that morning, the stock went down tens of percents, really a lot, and I was not able to do anything. So that was kind of a wake-up call for me to realize it's very difficult to outsmart the market, even if you're Martijn.
Even Martijn has biases. So thank you. I actually hear two biases, right? The overconfidence bias,
Yep.
which is very difficult to not have that. I would say, right? I mean, if you had 2-3 trades in a row that were positive, the fourth one definitely I know it. I know I'm better. But I wanted to say arrogant, but that's or some form of
human,
like overconfidence. So let's just keep. Yeah, no. But I also hear the home bias, because you mentioned Ahold like close to home. Something very familiar, which is happening with a bit bigger and professional investors, by the way, as well.
Yeah.
And why is it a double, like it's a problem because you get more exposure, more concentrated exposure maybe to one region, your own region.
Yeah.
But there's another reason that maybe for home biases is not a good thing, because it's probably too much correlated to your own home situation, or not? Or
probably true.
Almost diving a bit into a portfolio management now, but
but it's definitely well. First of all, it's definitely biased, and it's also definitely something you want to avoid. And not only because of risk mitigation, because yes, if you only invest in Dutch shares, you're too limited maybe. If they are multinational companies, then that problem is a little bit less of an issue than when it's all just local small cap companies. But still, it's an issue. And by the way, one of the reasons this probably is happening is that there is, and this is not per se a bias from the investment world, but more from general psychology. Things that you see more often, you tend to, admire more. You tend to appreciate more. So it's probably for that reason that local companies are more on top of mind, and you think they're better, and especially if you have them. This is another bias. It's something you already own. You'll definitely appreciate that better because, you bought it, so it must be a great company.
Yeah, ASML makes you proud now, right? It's a Dutch company.
So there's definitely that bias to keep in mind. And stepping back from sort of the general psychology and going back to investing, one of my sort of mantras when it comes to investing is diversification. People should make sure they diversify. And I really take that quite serious. So I think that's also one of the big reasons I'm a fan of ETFs when it comes to investing, because you can buy a global equity ETF that invests over hundreds of companies worldwide. Therefore, diversifying your assets really nicely. And it's way better than picking 2 or 3 local companies and put all your money there. Because I've done that. I've seen what happens when Ahold goes down. And I really sort of pay the price, learned my lesson, not doing that again.
Good to know. And if you're investing in a few individual shares, keep it probably a relatively small part.
There's definitely a core satellite approach possible where you have the big core of your investments in hopefully a couple of well-diversified ETFs. And if you then put a couple of percent of your overall holdings into a couple of companies that you really believe in, that's fine, because you're probably going to be wrong, but it doesn't hurt you as much.
When I go back to April 2025, President Trump introduced these tariffs. The markets were not really expecting that.
Not amused. Nope.
Not amused. Markets were down, I believe, something like 20-ish percent in a few days, or 15 or 20, something like that. Be honest, were you a little bit like panicking, or were you like, it's a perfect moment to buy? Because
Well,
I hear panic here in
yeah,
the
no, I can
company.
imagine. Yeah, I don't want to sound overconfident, but I do have to say that I no longer really panic in situations like that. I do get that feeling in my stomach that most people get.
Yeah, yeah,
But I recognize it now. And what I always tell people is you want to make sure that, first of all, you manage your own expectations and that you already, even when things are peachy and
yeah.
everything is fine,
Beautiful,
you
fine.
still have to every now and then remind yourself that there will be worse times so that you prepare a little bit for that.
Say like a 20% can be cut off.
Yeah, you have to sort of realize that that will happen at some point, and also you have to prepare yourself, or you have to prepare your portfolio for that a bit, because if I were convinced that the markets would only go up, I'd probably
Yeah,
be 100% in equity, maybe
yeah,
even with a leverage.
but
But I
exactly.
hate
Yeah,
leverage, so
yeah.
don't do leverage. It's not good. Maybe we'll explain later.
Part
Otherwise,
three.
look up
Yeah,
on our ETF Academy. So I know markets will not go
yeah,
just up. So that's why I have also some fixed income in my portfolio. That's why I also have, well, a couple of trading firms in my portfolio. For this podcast, maybe a little bit too detailed, but still, it's also why I have some gold exposure in my portfolio. I try to have certain assets that don't necessarily correlate with the equity markets, so that if the equity markets go down, some of these assets like
yeah.
fixed income or even cash, I always have like part of my portfolio in cash, because that will
Set
not
ready
move.
for.
And then you can actually benefit a little bit from those drawdowns,
Yeah,
because the second thing besides diversification I always tell people about is reweighing your portfolio. So if you have this asset allocation that you decided on, and let's
yeah.
say you're quite young, so you can have maybe 70 or
Thanks,
80%
Martijn.
in equity,
Yeah,
you still need to have maybe 10 to 20% in fixed income and
yeah.
or cash, so that if the markets go down, you will find yourself in a different position. So the 80-20 is no longer 80-20, it's maybe
Exactly.
70-30. And that means that you have to increase the 70 back to 80 by buying some equity. And hey, now it's getting funny because equity prices are down. So you
Exactly.
buy some extra equity at the low moment.
So basically setting an asset allocation for yourself and rebalancing occasionally obviously makes you buy more when it's lower and sell a little bit when it's higher.
Yes,
Did you do that with your gold position?
I actually did.
Oh,
Yeah. And
there we
I
go.
actually was about to do it for the second time.
Yeah,
And
yeah,
well, the markets
yeah.
didn't go up enough. But yes, I
And
did. So when gold went up, I did sell some. I think the gold price probably at that point was around the level that we are now, so 4,500.
yeah,
And at 5,500, I was about to do it again, but yeah, it
yeah,
wasn't
yeah.
at that point long enough.
You
So
were
yeah,
procrastinating. No,
we'll have to wait to see.
yeah,
No, but it's
yeah,
yeah, you always have to also manage your own expectations in the sense that there's always going to be a better moment. So as long as you at least stick to the plan, um, well, let's say good enough, it's already like a big upside. But there will always be better moments to reweigh, and
yeah,
yeah, that's something you have to live with, I guess.
yeah, yeah.
But reweighing
Exactly.
every
Yeah,
now and then is better than not reweighting at all.
yeah.
So yeah.
How can I how can we change our mind, and you started with being cautious of it, or being recognizing the bias, because I know I was talking with a few years ago with someone from the pension no, not from the pension board, but an asset manager of a pension fund, and that was the time that the interest rates went up quite fast, quite a lot. Well, what happens when the interest rate goes up quite fast, your fixed income value of the portfolio plummet.
Yep.
That was when they had to rebalance. And actually, the pension board, they said, yeah, we don't dare to rebalance now because, yeah, it's going so, or maybe should. And that was for myself another eye opener, that even if you're supposed to be
a professional,
exactly
rational
professional,
person.
rational person, investor, experienced investor, that you're
Even
still
then,
trapping into those biases.
yeah.
And I recognize it myself as well. When the markets went down 20%, yeah, well, you, Martijn, you only had a little bit of that feeling in your tummy, but
You had a lot of that feeling.
I had a lot of that feeling, but now, yeah, but I knew from theory, okay, that's the moment to basically be counterwise, but be buying that. But what I noticed is that colleagues that were investing as well, they were like, yeah, oh no, what's happening? It's sort of like panic, and I couldn't help myself to feel a little bit of that panic feeling as well. And how can I make sure to not feel that? Because yeah, we discussed it in part 1. Don't time, be rational.
It's very hard, but there's a couple of ways you can mitigate it, at least. So the first one is the easy one. We mentioned it, I think, in the first part. Try to avoid looking at the markets too much. Because the more you look, the more you will be incentivized to do something. You want to have that feeling of control. Now, obviously, it's hard, especially when markets go down 20%. There's no escaping it. You'll find it on your socials, on TV,
and you really think this is the new normal,
People
right?
will tell you about
it. It will never recover again.
Yeah, so it's hard.
Yeah.
But one way to deal with it is to basically have rules for yourself. And to prepare yourself, as I said earlier, that there will be times like that also in the future. So this is maybe also for yourself a good moment to already think about it. Okay, this will happen again. Remember this conversation, and next time it will be a little bit easier. But it's also one of the reasons I really like ETFs and passive investing, because passive investing is actually, in my mind, the wrong term. It's been sort of, people have sort of, people came up with the term active versus passive, where I think it's more whether you invest rules-based or more emotional. Active investing is more emotional investing. You basically are able to do whatever you want at any given moment in time. It's active, but it's also very emotional. Passive investing or ETF investing is very rules-based. So ETFs, they follow an index. An index has, periodical rebalances.
Exactly.
But it can be a quarterly rebalance or a semi-annual or an annual.
Yeah, or even equally weighted.
But there's no subjectivity involved anymore. So there's no emotion involved. It is a clear set of rules, which basically states at this point in time you need to do something. This is what you need to do, and that's it. And then you wait until the next one.
Because you create these rules when you're rational. There's no emotion with it and stuff like that.
So even in our case, if we have, let's say, in the AEX ETF, it's the well-known Dutch index, so it's a good example. If at some point ASML goes up really far and there's a reweighting, we do need to take some profit, because we have to sell part of the ASML position because of the reweighting. So even though emotionally we may think, ASML could go a lot higher, we're not allowed to do that. It's rules-based, and same goes for companies that go down. We may feel that feeling in our tummy saying, you should probably not buy that at this moment.
Yeah, like but Tesla 5 years ago or something, right?
You simply have to buy it. So you basically take out the emotion. If you follow a passive approach, if you follow a rules-based approach, it's called rules-based for a reason. There's rules, there's rationality, and you try to take away the emotion.
And then you can create rules like, okay, if the market goes down more than 20% in 1 week, I should see it as a discount, buying from my cash X, Y, Z.
Yeah, well, I guess the one of the ways you could look at it is you don't even have to look at what's happening in the market. You only have to look at your portfolio, and your portfolio will tell you what to do. Because if you had that 80-20 allocation between assets, equity assets, and fixed income and cash, if at some point in time your portfolio all of a sudden is 70-30, hey, I have to buy more equity to go back to 80-20.
Exactly.
And so your portfolio tells you what's going on.
And then look at your portfolio and then the rules. Basically, the more rules, or the more strictly you follow your rules, the less room there is for the emotions.
Yes.
Okay, so basically you're saying you should be a robot in terms of your portfolio,
I think
more or
yes.
less.
Robots would be very
Right?
good investors.
Rule-based robots,
To make it maybe a little bit more scary, psychopaths are also very good investors because they also tend to have less emotions. But yeah, let's not try to become psychopaths, people.
That goes too far. No, let's not
Robot.
do that. No, robot good. And too much emotions. Keep the emotions in the real world. But okay, so let's say you have this beautiful rule set. You're only looking at your portfolio, so lots of rules, and you're very good at strictly following the rules, even though there's panic in the market.
Yeah,
I'm following these rules. Good job. But now I hear everybody around me. Well, now not so much anymore, but everybody around me. Oh, gold X, Y, Z. Let's take it 2 weeks ago when gold was like. It almost looks like a long short squeeze, looked like a hype. If you looked at the chart, everybody would, well, not everybody, but a lot of people would say, it's a bubble. So no, you saw the theory, but then no, this isn't a bubble. This time it's different. This time it's cost because X and Y, Z. And then you hear colleagues and a lot of people, even at the hairdresser, they're starting to, invested in gold. And it's to a person, it's very difficult to not think, oh my gosh, everybody is profiting from gold. I'm not doing it yet.
No,
Should I?
It's hard. It's hard, and you always have to keep in mind too that a lot of people that are talking about it may have only invested very recently, or are not invested at all, but are just talking about it. And everyone likes a good success story, right? There's not many people that will tell you, well, I invested in OWL, then it went down 40%.
No,
that's only
not like that's a weird birthday story, right? Well, it could be, but
so yeah, you have to keep that in mind. Obviously, people love to share their successes, and it's very human to be a little bit envious. If all of your neighbors are making a ton of money, you want the same thing. But
or having that expensive car, or the account,
But it's kind of a bias too, and it's obviously the fear of missing out. There's so much written about that.
And why is that hairdresser or your colleague saying it? It's not a bias. It's probably like the confirmation bias that if I would tell you, oh, Martijn, I invested in gold, and ideally, but somewhere back in my mind says, oh, Martijn is experienced investor. Maybe he says, great idea, good job, Kees. Is looking for that confirmation.
Definitely, and especially these days on social media. You don't even have to look for confirmation anymore. If basically based on your own search terms, the algorithm will find it for you and will start feeding you that confirmation. So it's really easy to go down the rabbit hole. So maybe to become a good investor, you should also leave social media a little bit aside.
Basically, you say the more robot, the more rule-based, the more boring you invest, the long term, better.
Boring is beautiful.
Yeah, and don't be envious of that one person or two person that made a ton of money with Bitcoin or with
There's
gold.
Always the exception to the rule, and the exception gets a lot of attention. Basically similar to what we said in the first part of the podcast. If something extreme happens in the markets, the media will write about it, will talk about it, will broadcast about it, but all of the time that nothing really special happens, you don't hear about it. So it's always these exceptions that get magnified and therefore get a lot of attention. And you think that's normal, but it's not. It's the exception.
Would you even say that you should invest? If you're investing on the short term, that you should invest maybe counterintuitive even, or is that going a bridge too far?
Well, it's maybe a little bit too far because that also implies an active strategy. But it could be a rule. And if it's a rule, then maybe it's a little safer. Well, I think at least I would, if I were to do anything, I'd rather follow Warren Buffett's advice and become greedy when everybody is fearful and become fearful when everybody's greedy. That's probably better than the other way around. But still, I think in the end, it's better to be agnostic, to be honest.
Looking at the statistics, there's still relatively a lot of male gender male investing or trading, at least investing maybe not so much. even though there's enough research that female investors are doing on the long term a little bit better. Is that, I'm not saying that the female gender is more robot, but what is that, has that something maybe to do with some other biases that are maybe emphasized more with men, or
Oh, for sure. I think
the overconfidence bias, maybe.
Definitely the overconfidence bias. I think this also shows in academic research on people that apply for jobs.
Yeah.
Now, a male applicant will look at a vacancy and say, well, I think I can do probably all of this. It's fine. I'll apply for the job. A woman will look at it and say, I can do most of it, but this, I don't think I can do it. I should probably not apply. So it's yes, there's definitely an overconfidence bias in most men, and yeah, that makes them vulnerable. But also they are more competitive, so they're more eager to try to do a little bit better than that annoying neighbor.
Which taking more risk.
It means taking
more risk is.
It means trading more often, and yeah, that usually leads to worse outcome. There's a lot of research done by brokers across the globe. And all of it basically shows that the more active someone is in their portfolio, the less results they have. So women tend to be less active, they trade less, and they tend to have better results. Yeah,
I feel part 3 coming up of the podcast. Okay, to sum it up. Right, because make those rules. So once you start investing, make these rules.
Yeah.
Do you know where we can? Would you mind sharing a few of those rules that you have for yourself in the comments? Probably in Spotify is the easiest.
Yeah, sure. We can
just a few rules
later.
Yeah, exactly. On a personal note, obviously,
yeah,
or
sure.
we can make it a mix of mine and yours. So following a set of rules. And making sure to not be, when the market goes down or when there's a FOMO moment or lots of emotions, stick to the rules.
Yeah, and to help you do it, I would actually recommend people write down the rules.
Yeah.
And not just typing, but actually writing it down, keeping it somewhere in a safe place. And if something happens in the market,
first have to read the rules.
Read the rules first. And then decide whether you still want to do something.
Yeah, or you should, if you have a partner, that your partner is like the investment committee, that he or she...
Maybe 4i principle.
Exactly, has the rules, like, is it meeting the rules? No, map.
Yeah.
Yeah. Okay, maybe, that's something probably might not be encouraged by platforms that incentivize trading,
no,
but...
Not.
So ideally then going back again with part 1, find a platform where trading isn't that much or is not at all incentivized.
Well, or
because trading
as
more
I put it earlier, as long as you're aware of your weaknesses and if you're aware of the fact that trading too much will probably lower your outcome, if you're aware of it and you have a certain amount of discipline,
aware,
you should be okay.
Rules,
and
discipline. And it's so nice to know that even Martijn still has behavioral biases that you trap into. Martijn, thank you so much. Can I offer you a candy, by the way?
Well, can we turn off the camera for now?
So, thank you so much. If you have a question or a comment for Martijn, well, you're easily reachable on the socials. Don't follow the socials too much around the market movements. Or leave a comment on Spotify or LinkedIn. Thank you so much, Martijn.
Thanks for having me. It was fun.
I'm looking forward to maybe future episodes that will come. Cool. Thanks.